Thank you for standing by and welcome to How to Enhance Your Customer Due Diligence Risk Identification and Deliver Increased Efficiencies conference call. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you would like to ask any questions, you may submit them through the web by clicking on the Q&A tab. I must advise you that this conference is being recorded today, Thursday, the 6th of November 2014. If you require technical support at any time, please press *0 on your telephone keypad. I would now like to hand the conference over to our speaker today, Ms. Helen Spicer. Please go ahead.
Okay, thank you very much and welcome to our webinar today. I'll say good afternoon and good morning. So in the next 40 minutes today, what we'll discuss, initially we'll look at some key challenges that today's onboarding teams face. And then secondly, we'll look at 5 areas where we feel it's possible to enhance your customer due diligence risk identification and deliver increased return on investment. And they are creating the right compliance culture and ensuring verification of the right entity quickly first time, integrating your credit and compliance policies, strategies for meeting your beneficial ownership challenges. 4th point will be a one-step solution for comprehensive risk screening of beneficial owners. And lastly, identify sanctions and other high-risk entities in your third-party relationships. We'll then finish off the webinar with a question and answer session. And if you can ask any questions through the online portal as we go through, and we'll aim to get through as many episodes that we can. And now I'll hand over to our presenters today, Paul Westcott and Rupert Ruig.
Thank you, Helen. Firstly, let me provide you a quick overview of Dun & Bradstreet and myself, and then I'll hand over to Rupert to do the same with regards to RDC. Dun & Bradstreet is the world's leading source of commercial data, analytics and insight on businesses. We have more than 240 million business records in our database, linked with our unique DUNS number, and we develop solutions to help finance, marketing, procurement and compliance functions deliver efficiencies and competitive advantage throughout their critical business functions. We have been delivering the data and insight regulatory compliance professionals require to identify and verify entities on a global scale for many years, long before the 2007 EU Money Laundering Directive. With our unrivaled global reach and coverage, plus our ability to connect content together, we resolve many of the compliance challenges of today. Personally, I've been working for Dun & Bradstreet for 5 years and primarily am responsible for delivering the compliance-led solution with EMEA. Most recently, I've supported our international expansion of D&B's latest compliance workflow tool, D&B Onboard, into the United States, Canada, France, and Germany. Rupert.
Thanks, Paul. Hello, everyone. My name is Rupert de Ruig. I'm the Managing Director for RDC, or Regulatory Data Corp, in Europe. I've been working with financial institutions and corporates for over 10 years now to help them manage and meet the challenges and expectations around anti-money laundering, sanctions compliance, and more recently anti-bribery and corruption areas of risk. RDC today provides the risk diligence engine to D&B, which enables their customers to seamlessly identify regulatory, reputational and commercial risk. And I look forward to speaking later in the presentation.
Thank you, Rupert. In this webinar, we'll look at some practical things you can implement or work towards to minimize some of the challenges you have and your teams are facing today. We understand these are many and varied, but we selected 5 themes that could be adapted or adopted to fit numerous organizations. I'll look at the first 3, followed by Rupert. However, before we look at these, let us just see some of these ideas in context around the challenges you face. When working with many of our clients, I can see that onboarding and customer onboarding teams are being squeezed externally, and the increasing regulatory demands, but also internally with demands to deliver more efficiencies and cost savings, whilst under increasing scrutiny of the board and wider organisation. So let me break that down a little. On top of the business as usual requirements to conduct AML KYC work, and the fourth EU directive will ultimately add yet more scrutiny to this discipline. There are other areas of concern that include general trends for regulation to demand more of your process, your data, and your people. For example, take Basel III or the BCBS 239 requirements that demand you create internal risk ratings to assess your counterparty risk, implement data aggregation, and create an enterprise-wide risk assessment. BCBS 239 requires you to think hard about your content, your data quality and its timeliness, accuracy, comprehensiveness and clarity, and the data lineage and root cause remediation, how you manage on-demand and ad hoc reporting capabilities, as well as automated risk aggregation. It requires you to consider data infrastructure, integrated taxonomies, standard identifiers, for example, like LEI, as well as standard naming conventions. And it also wants you to enhance your governance models that you have, documented policies, procedures, executive management accountability, control against the full life cycle, service level agreements, as well as independent audits. Another significant milestone this year has been the release of the Common Reporting Standards and the commentary in the summer by the Organisation of Economic Cooperation and Development, or OECD. This process has great similarities to FATCA and an area I suspect many of you have been working in the last 18 months. It seems clear that data governance, risk mitigation and regulatory compliance activities are coming together due to the similarities of data acquisition and the skill sets needed by individuals and the adoption of well-documented process. Regulatory fines are the sword of Damocles above all institutions, and recent fines on Standard Charter, BNP Paribas and PwC for AML or sanction breaches highlight that the regulator is willing to look closely at any firm. However, onboarding an AML risk should not be seen purely as a regulatory matter. Indeed, organisations that do not see the opportunities in a rich seam of client insight and data that is developed at this critical stage miss the potential to make content work hard and more efficient for them and drive better insight and create sustainable growth for their business. Account opening based on products or engagements, the traditional approach is changing. The need to understand holistic risk against the client, whether that is regulatory, operational or reputational, actually can drive cultural change, placing onboarding at the heart of achieving business drivers rather than a tick box exercise. Some of the current AML drivers seem very consistent: establishing and setting the correct categorization of risk, being more efficient with budgets, establishing your exposure in complex ownership structures, or getting the right data quickly and onboarding a customer with fewer touch points, delivering that consistent approach. What is clear is that the content on an entity and a more holistic view on risk on your clients, related parties, vendors, suppliers and counterparties is absolutely critical. So with that maelstrom of external and internal pressures in our minds, now let's take a look at 5 areas to consider that could be implemented or adapted to help you address today's challenges of client and risk identification. I will take a look at the first 3, then Rupert will carry on providing insight into the others. So the first area I would like to touch today is creating the right compliance culture and how ensuring that you verify the right entity as quickly as possible can ultimately support improvements of your return on investment in your KYC or KYB processes. Delivering decisions in your organisation the past 10 years may have been seen by some as just an exercise that's something that had to be done and is an expensive inconvenience. Often there is an inconsistent understanding of why it has to be done and seen as purely as a compliance department's job. But regulatory driver alone will not bring client onboarding to the forefront of board's thinking and will not drive cultural change. This lack of understanding across an organisation can also lead to different processes and policies being introduced in different parts of the same organisation to get to the end goal of being compliant, particularly if the drivers of secrecy within facets of the organisation are foremost in the minds and the risk categorisation is solely driven by work, matters, products, sell in front of them rather at that point in time. Changing the culture in any business is perhaps the hardest thing any board will try and initiate. Often it stems from poor growth in sales or a need to drive better shareholder value. But it is unlikely that they think due diligence or client onboarding is where they can actually achieve any results. But enabling a culture where holistic risk management is part of the organisation's DNA rather than just around AML, and providing your onboarding teams with the tools and data they can all access in one place across the organisation to allow quick identification and verification at the start of an onboarding process can provide some real significant advantages. Firstly, we can move towards a single version of the truth. Having the tools and data that support and drive your organisation to make corruption as well as statutory compliance an important aspect in all team members rather than those involved in KYC. Is the single source of truth really achievable? And is it what we really need? Perhaps as we look at delivering data governance models, there is which are single entity driven, but crucially with multiple versions of the truth that are managed appropriately, providing the right insight to the right user. For example, the legal entity view of an organisation that somebody needs to establish a working relationship with will be far different to other internal use cases. For example, business development, front office, your chief compliance officer and risk. They will all need different flavours of the same ultimate entity. But why should these be held in different places and not connected? Secondly, if we can improve transparency, we can deliver a cultural change despite the initial potential risks it seems to pose. If a person can see the number of engagements or transactions that they have with a target organisation at an entity or counterparty level, it will enable them to deliver better categorisation of risk and establish, for example, a tier N approach to vendors and suppliers, or a stronger, more resilient revenue it could be achieved. It is only through transparency and connecting multiple risk data attributes that aggregated risk, regulatory, reputational, or operational, really becomes apparent. If I move forward to the second area we're going to look at today, which is integrating your credit and compliance policies. The initial reaction to cash-rich customer for your trade credit risk and CDD teams can at first glance seem poles apart. Additionally, your needs for onboarding vendors or suppliers might seem different to the ongoing credit risk perspective you have today within your supply chain. Of course, cash is king in the organisation's credit policy, but can be a red flag in an AML or anti-bribery one. But bringing risk elements together clearly enables better, more efficient decisions that drive sustainable growth for a business. If you look under the surface, many of the risk assessment checks required as part of an anti-AML policy will have already been carried out or could be carried out by your credit management teams, whether they are customer or supplier side. Questions such as who are they, where are they, what business do they do, who is behind the business, are asked in many different departments in many different policies. Therefore, there lies within holistic risk a significant number of synergies to drive efficiency. The flow of onboarding a customer, verifying them, maintaining evidence and ongoing monitoring are the same processes, but with just different signals for credit and CDD teams. So why not merge these processes but manage the right signals together? Ultimately, the end result is to report effectively to a customer and the content to a consumer of the content you are providing. By looking to bring together strands of risk, reporting can become simpler for the end user to understand. Imagine if in one deliverable you can supply regulatory risk, reputational risk, potential for bad debt, probability of insolvency, your aggregated risk position on associated entities, or your aggregated risk for a tier N supplier in your supply chain. The power of easily reviewing all these risk factors together rather than part is very obvious. Client or supplier onboarding has the potential to think in terms of a holistic risk and to be entity-centric to achieve this objective. By streamlining your organisation's onboarding or supplier vetting policies, you can save time, reduce multiple checks, and the same organisation, which can lead to inconsistencies of approach and outcome. it also becomes easier to communicate to stakeholders, including sales, why credit and AML decisions are made. If stakeholders understand why an engagement or a supplier approval is being held up, they can support that rather than be resistant to the compliance objectives. Ultimately, this would require the right stakeholders to engage in this process, but increasingly the drivers of regulation, such as BCBS 239, are actually forcing organisations to think in these terms. Finally, I would like to look at beneficial ownership. In March 2014, KPMG surveyed over 1,400 compliance professionals across the globe. In that survey, they identified challenges such as correctly categorising risk, driving a consistent approach to compliance process, things that we have touched on already in this webinar. However, the single biggest issue they identified was that of establishing and maintaining complex ownership structures. Traditionally, you need to understand legal entities and how they link together and the relationship between them. But for AML KYC policies today, increasingly you need to understand all of the indirect and direct beneficial ownership strands to get to the person or persons that are the ultimate beneficial owners. At D&B and RDC, we have been looking at some ways to help you achieve and more easily, more accurately and ultimately more cost effectively drive to this position. Firstly, I'd love to say that there is a way that a person in your organisation could press a button and the data software solution could identify the ultimate beneficial owner every time so you could move forward. Clearly, the G20 have been clear on this as a driver post-financial crisis. But despite some local unilateral developments, and in the UK, BIS is an example, globally the transparency of information is some way off due to conflicting local laws, lack of will in legislative, or to collect the data, or could I say that some financial advantages are gained if you limit information publicly available on corporate entities for some areas. We suggest that you think about where shareholder information is available globally and focus on aggregating that content together in a way that provides a single, global and aggregated view, making it simpler for any user in your organisation to use and understand, and therefore deliver beneficial ownership efficiently. Secondly, implementing a process to be able to remove or discard those organisations and individuals that you don't need to carry out significant levels of work or investigation on, allowing you to pinpoint those entities that you need to prioritise and focus your beneficial ownership effort on is critical. Of course, a level of automation for this will be essential, but do not limit yourself to hard rules based on process that cannot adapt to change. For example, recent OFAC guidance on multiple shareholders, each with small stakes, say for example a 10% holding, highlighted that regulators understand the old views of 25% and above leave potential gaps. Would your policy, if each of a 10%er are sanctioned themselves, ensure that the entity in which they hold the shares is also considered to be sanctioned by you as well? If you take that level of understanding and use it in other areas of your KYC workflow, you can then drive more efficiencies, for example, through screening. If you make that data easily exportable for internal use, so that other teams can quickly access your investigations and findings, and therefore reduce multiple checks on the same entities within your organisation. As I highlighted earlier, RDC and D&B are working together to deliver a single global view of corporate and individual share ownership and make it easy for you to screen those entities and reduce your risk exposure. And it is at this point I'd like to hand over to Rupert of RDC.
Thanks, Paul, and hello again, everyone. So in my couple of topics, I'm going to be looking at comprehensive risk screening of beneficial owners and the entities that they're connected to, and also discuss some workflow activity that you could consider to achieving this. So before I go there, I want to talk specifically around what are the constituents of what we mean by a comprehensive risk screening. And I think it's accepted now that there's sort of 4 key elements or types of risk that you would be concerned about from a greater or lesser degree. Top of the tree, of course, has to be sanctions. They come in various forms through numerous different lists and reflect the foreign policy of tool of choice that we've seen regularly over the years. And the use of sanctions has been increasing exponentially year on year, despite expectations that might cease. They can come in various forms. The blunt instruments, such as narrative sanctions around trade or export embargoes impacting an entire country. They can be more tactical, where they name specific entities and particularly people, vessels, crafts, and companies. And they can be, and debatable if this is the right term, but more strategic in their guidance, such as the recent guidance about ownership, and that any entity that's owned in aggregate, either directly or indirectly, by one or more people that are blacklisted, is itself to be considered a blocked entity, even though it may not appear on any list from any institution. There are many lists. As you can see, some of them are shown here in the logos. Change is constant and can happen without warning, although in recent times the changes have been quite well flagged, probably for political reasons, that new entities are going to be added. But we've also seen entities being removed as well. There's significant duplication between the lists. They tend to follow each other significantly, and therefore over 50% of the entities on these lists are common and the same. And therefore it's important to approach and look for risk in a consolidated view. So companies like RDC would consolidate these entities that are on the list into a single profile, so that you're not wading through multiple alerts and multiple instances of the same entity. Away from sanctions, but also from official national and international bodies, would become the what we call government and official lists. And this can be anything from an enforcement order, an exclusion list, such as a corporate disqualified director from a corporate registrar in a country. It could also be law enforcement lists, either national or international in the case of Interpol, trade restrictions, even war crimes, and other warning notices, all from official institutions published online, and can be listed in their hundreds. And again, it's important. Not necessarily doesn't mean you cannot deal with entities on these lists, but certainly it's a very good warning flag for you if you find that you're dealing with a person or a company that does appear on lists from these institutions. PEPs came to prominence with the revision of the FATF 40 recommendations back in 2004, was adopted into regulation for anti-money laundering sort of a couple of years later, primarily here in Europe and around the world. And the screening of foreign public officials has been undertaken by financial institutions around the world for some years now. As we all know, that is going to continue to evolve. FATF have published new guidance, which has now been adopted into the AML 4th directive in Europe, which means that domestic PEPs should also be screened by financial institutions going forward when that's passed into law. Certainly, many financial institutions already screen their client bases today for domestic PEPs as well as foreign individuals. PEPs have also become, and you could consider them public officials as well, equally important in the world of anti-bribery and corruption, particularly as regulations such as the Foreign Corrupt Practices Act and the UK Bribery Act talk about public bribery of public officials, identifying if you are dealing with these individuals or people connected to them as a corporate institution, or indeed a financial, of course, and is important, and ensuring that behaviour and that relationship is ethical and above board is very important, and enables you to take a risk-based approach to the way that you're engaging with politicians. Regulators all agree that it's the senior PEPs that are the concern. Of course, middle-ranking and junior officials have the ability to carry out bribery and corruption and use their position for personal gain. But in the case of the fact that of the many millions of PEPs that are public officials that are out there, the senior slice is seen as key. As is the focus on relatives and close associates is also very important. How often we've seen the PEPs, the close associates of the PEPs involved in the money laundering activity or the corruption activity, given that they potentially hold a degree of anonymity compared to the individual themselves. It's also important to look at the fact that not all PEPs are equal. Again, a debatable topic, but the influence of geography is very key. If a PEP is coming from a more region more prone to corruption, that is obviously increases the risk with dealing with such an individual. Regulations such as guidance from the Transparency International Corruption Perception Index is a good example of useful information. Job roles too can be indicative of corruption risk, and of course links to negative media for the individual or people that are linked to them. If they have negative media in their background, so too will increase the risk associated with these. And companies like RDC now produce risk scores around each individual to give you an idea about how those factors would influence the risk associated with a particular person. And then last but by no means least, on the types of risk screening that you may wish to undertake, is adverse media. And adverse media screening is an increasing regulatory expectation. We're seeing that particularly in Europe and North America right now, where regulators are saying to financial institutions, not only do we want you to carry out PEP and sanction screening, but we also want you to check entities for any negative information in their past. The good news about this is not only is this potentially a regulatory obligation, but it is also it's good for business, essentially. It enables you to protect yourself from dealing with a company or a person that may actually pose a particular risk. So in a way, there's some significant benefit of doing this sort of background checking. What is adverse media? Well, it can be a range of different types of risk. FATF themselves have published a list of 21 different offences. They call their predicate offences, which are primarily focused on financial crime, but you can see them listed here. Things like terrorism, financing, organised crime, of course, money laundering, corruption and bribery, fraud, tax crime, and so on, are all risks that would be considered, certainly, if you are dealing with an entity that has that associated with them of particular concern. But they're not the only risk types, as we can discuss in a moment. So those are the risk types. So how would you look to employ that within your risk management processes? Well, you can see that the risk, and this is a definition taken from the RDC adverse media coverage definition. RDC is built on the FATF predicate offences list of crime types, and increased to add additional crime types that would also be considered of concern to our customers, providing a definition that we apply to every country and a territory in the world, looking for companies and people that would meet it. And it builds out the risk picture for you, going beyond the predicate offences, and enables you to look at crime beyond financial crime, environmental crime, a broader brush of business crimes, for example, crime against the person, such as assault and battery, murder, and of course, all things that you would want to be aware of potentially about a particular entity. We then combine that into our database of risk. You look, and again, you can see here the three different primary buckets of risk: the sanctions and the official list that we just talked about, the PEPs and the adverse media. Creating a database of over 6 million profiles of risk, unique profiles of risk, of entities that you may be concerned about, which we integrate seamlessly into the D&B platform. So how does that manifest itself in a benefit if you want to carry out your risk screening? Well, I've got 3 or so examples for you about how risk screening could help you manage your risk and how you'd be able to identify it. In this first example, we have a company called Nelfin Trading Limited. They're an organisation based in Dublin, in Ireland. When I checked on them yesterday, I actually found out that they were out of business as defined by D&B. And through the tool, I was being able to simply carry out a seamless check of the RDC database to find out more background about this organisation. A quick search on that then revealed this risk alert. And you can see that Nelfin Trading had some issues with some environmental crimes around their activity, where they were prevented from accepting any further waste. They're a waste management company at the time, and they were prevented from accepting any further waste and given some clean-up orders. You can see within the profile that we had on our database that we had a link to the source information. If we were to look at the source information, we'd also see that the company was cited by the judge as being in financial difficulty back in 2010. So here you can see the advantage of when you're carrying out your checks on this company and identifying the background to the organisation through the D&B data. You can then, back in 2010, if you've been carrying out your checks, you'd also be able to see that there was these litigation issues and also these commercial issues about the entity, which ultimately clearly resulted in them going bankrupt. The next example is a company based in New York called Navigate Incorporated. They make sales software for corporates around the world. And in this instance, we've been able to carry out a director check. Again, very simply, the user would be able to select the executive. In this case, his name is Greg Ruig. You'd click on that name, and you'd be able to see that Greg Ruig a few days ago was arrested in New York by the Department of Justice for what appears to be counts of wire fraud and securities fraud by the Department of Justice. Again, you'd be able to link through to the full information that supported that information, getting links to the Department of Justice news releases, but also other media releases. And in this instance, we can see that Greg Ruig has been falsifying his financial statements and official communications to his investors, citing he had a lot of money when he clearly didn't have access to any, which he is now under arrest for. Again, obviously a major red flag if you were had a business relationship with this entity, with this company, or were looking to work with them. And then last but by no means least, we have a company called Hon Hai Precision Industries Corporation. They're based, this particular branch of the company is based in the UK. Again, a quick check on this company would reveal initially that you can see that that this company is actually has an alias or what goes under the trading name of Foxconn. Foxconn has hit the media for a number of years now around their relationship with Apple and some negative stories around that. In this case, more recently, a former Foxconn general manager has been detained for allegedly taking kickbacks from partners in the supply chain. Again, probably not, maybe the actions of a rogue individual or executive, but also potentially an indication of weak processes and controls at Foxconn that would want you or lead you to carrying out further due diligence on your relationship with that organisation before you undertook a business partnership. So that's really the update from me, from RDC, to show you the sort of types of risks that RDC that you may be interested in, but also how you can use RDC with D&B to manage your risk and identify risk very quickly around an entity. So with that, I'm going to pass it back to Paul.
Thank you, Rupert. So before we go into the question and answer section of the webinar, let me try and bring some of those themes together. I guess D&B and RDC here believe that for future AML and KYC risk assessment lies within the transparency of collective thinking. If you can achieve consistency of results, you can drive better value of your process, and you can actually see that a client onboarding as a growth engine. But to do that, you would need to have a truly global joined-up approach to your AML processes. In addition, a more holistic approach to risk mitigation is required. The norm of reviewing solely for sanctions or PEP-based risk will not enable boards to be confident in their risk mitigation efforts, nor will it drive the much-needed growth in all of the businesses that you have. As we've demonstrated here, risks can come from many facets and need to be looked at multidimensionally. Only with a holistic approach to risk can change actually happen. Ultimately, workflow tools for onboarding, whether they're software or utilising web services for content aggregation and analysis, or out-of-the-box solutions such as D&B and RDC, can work with the processes that you are going to have to put in are going to become more prevalent in the marketplace. I guess we believe those workflow tools that are built from a content perspective as well as a user experience one will ultimately provide end users more value. Software can support our day-to-day activities in so many ways now, but ultimately the challenge is to have the right content in the right place at the right time to answer the questions your end users will have. And finally, whilst it may seem a far-off prospect now, it is perfectly possible that risk management and mitigation and the due diligence and governance invested in AML and KYC processes can be the catalyst for cultural change. This is not to suggest that organisations should be risk averse. Far from it. I would argue that the right level of governance, a holistic approach to risk, and a greater understanding of the goals and objectives of an AML KYC to the wider business would actually enable organisations to make better, more informed decisions and build a sustainable and ethical growth that allows your organisation to win more often. With that, Rupert and I would like to thank you for your attention, and we'll now address some of the questions that have been coming through on the webinar, and some of you have already posted a few. So, Helen, if I can pass over to you, perhaps we can start to review some of the questions that have come through.
Okay, thank you, Paul, and thank you, Rupert. Okay, if we look at the first question, to what extent do regulators expect you to see or to screen beyond sanctions and regulatory risk in customer due diligence, and where do you stop? I'll give that one to you, Rupert.
Yeah, sure. Thanks, Helen. That's a good question. I think, as I mentioned in my remarks, the primary focus for regulatory screening is focused primarily on sanctions and PEP, but we're seeing an increased regulatory requirement and guidance to look at adverse media type risk as well. That is evolving and developing, and as we discussed, it also has significant business benefit because you're identifying business risks that could harm the reputation or the business of your organisation. Where do you stop? Well, that's ultimately up to your organisation. It's important to work with data and risk information that's very clearly categorised and described, so you know exactly what the risk is associated with that entity. So, is this a regulatory adverse media, or is this a business crime? Being able to select the information or the risk type that you're particularly concerned about is very important, and you should look for that in the way that in the services and the solutions that you work with.
Okay, thank you, Rupert. Okay, another question we had was, it was highlighted in the presentation that shareholder information is not consistent around the world, and where shareholder data is available, what would you do if share ownership was not disclosed? I'll pass on to you, Paul.
Yeah, sure, thank you. We're absolutely right. Shareholder information is absolutely not consistent throughout the world. It's not even consistent in large countries such as America, where different states will have different views of shareholder information. But I think what we can do is start to pinpoint those countries that have a more consistent approach. D&B has information around 220 countries across the globe, of which we've now identified around 126 that actually focus on starting to deliver consistent shareholder information. So as long as we're capturing information on those countries, and we can deliver down to a reasonable level of shareholder percentage, ensure that we capture the individuals as well as corporate and minority and majority corporate owners, and that is now the policy that we'll have in terms of capture. We can very clearly state a process which allows people to say, move forward with this country because there should be information, or have a flow which is looking to get consistent information on beneficial ownership. However, if it's country X, we push the flow to a slightly different conclusion and provide that conclusion to the ultimate owner or the ultimate person who wants this information. So what we do is reduce the time and effort of looking for shareholder information that is never going to be there.
Okay, thank you, Paul. Another one we have is, to what extent can I connect the information I have to legislations like the UK Bribery Act?
Should I take that one? I can. I guess this is a really interesting one, and I perhaps spend as much time now with my internal compliance teams as I do with compliance teams externally, as we start to drive change in behaviour in D&B, and certainly from something from a UK Bribery Act, there's an internal perspective around training staff and supporting staff and understanding what is expected of them, as well as identifying and having good process to identify potential issues or bribery across the supply chain. I think what's important here is to not think of this as there is a panacea or an area where you can go and find organisations or people that have been indicted or supported by, or say that they have been under that UK Bribery Act position, although RDC does offer levels of that risk information and provides that through some of its adverse media. But if you have a robust process, you have that policies written down, it's a very clear evidence and guidelines to internal staff of how they manage that process, then actually that is a very robust legal response to any indictments or any issues that you may come across from a bribery perspective.
Okay, thank you, Paul. We'll just cover one more question today, then what we'll do, we'll endeavour to answer the additional questions that have come in the follow-up emails that we'll send. So finally, do you think that the move to outsource KYC activities supports the points made on the webinar around changing culture and creating a holistic risk approach?
Should we both have, well, I'll start, and if there's anything that Rupert wants to add. I hear a lot these days about KYC activity being outsourced, and is there a potential to have a KYC utility? I actually think that what we're doing here supports some of the points that we're making around culture and having a set of holistic risk. Because whatever outsourcing is undertaken, clearly that is a cultural change within the business, and every part of the business is going to have to understand what that means to them if they outsource KYC activity. And in addition, it's going to be very clear that as you work with a partner or somebody to drive your KYC activity, they've got to be very clear about the level of risks that you as an organisation are willing to take, and which ones that you would want them to drill down and understand, and which ones are not seen as essential to you and your business drivers. I think it's important to say, though, that whatever outsourcing happens, the liability of KYC will always end and will be at the door of the organisation itself, and not the outsourced piece that does the collection of data. Rupert?
Yeah, just a brief point, just to add on to that. At RDC, we do a lot of work supporting our customers, especially with the first level of due diligence, checking after the initial risk screening has taken place. The reason why our customers are increasingly using us for these sort of services is that the amount of workload that is on compliance departments and risk management areas of a business is increasing exponentially, and shows no sign of abating, and you can only hire so many staff. So if there is elements of the process, which there are, which are relatively simple, relatively straightforward, but demand high quality and significant amount of labour and work, that's an area that third-party firms can absolutely help, and RDC and others do that with great success. So I think that's going to be an increasing trend of this outsourcing of compliance going forward.
Okay, thank you very much. I'd like to thank our presenters today, Paul and Rupert, and thank you very much for your time for joining our webinar today. As just mentioned earlier, we'll send out email to follow up to this with a copy of the presentation and a recording, and we'll answer any additional questions that you have. Please feel free to respond to that email as well with any new questions that you may have once you've got the materials in front of you. So with that, I'd like to say thank you very much.
Thank you very much.
That does conclude our conference for today. Thank you for participating.